whilst Olivia gets her preso ready, I just want to pick up on a couple of points that Nicole made and make some comments generally about where we see we are at the moment. And one of the key factors was the mention about interest rates as being one of the levers that the federal governments can pull to influence the economy and to influence markets. So in our view, interest rates matter a lot. And then in particular, when we look at the interest rate that you're getting as investors via deposits versus the rates of return that we can get on other investments, that's probably one of the key things that, whilst rates are low, that's going to continue to drive markets. But the conundrum for us as investors right now is this low interest rate environment is continuing. It did try to turn around, or the Fed tried to turn that around late last year, and we saw the immediate ramification of that on the markets, which is the conundrum right now. We see low rates continuing, therefore it's interesting to invest in the markets, but we also see that economies are running at all-time highs, low unemployment, other various factors that indicate that they are nearing the end of their cycle. Therefore, we want to err on the defensive side for the inevitable correction that should come. The hard part is we don't know when it will come, but it'll be more than likely spurred on by a Trumpism, a trade war, or the Fed tinkering with the interest rates a little bit. So you will have noticed when we've had our review meetings with you that your portfolios are skewed, or we've been reducing the weighting on the risk side of things, and we've been adding more into the defensive side of the portfolios. And by doing that gradual altering of the portfolios, or gradual reweighting of the portfolios, is the recipe for trying to avoid a significant downturn should and when that happen. Happy to take or talk to you privately around that a little bit later on. Right now I'd like to introduce Olivia, who's going to touch on the federal budget announcements a little while back, but more importantly talk a little bit more around some of the differences in the political parties' announcements.
All right, so I guess in terms of what I'm going to touch on today, I'm going to touch a tiny bit on the federal budget. So obviously with an election called straight after the federal budget, it sort of throws things up in the air, and really not a lot happens until we find out what happens with the election outcome as well. So I'm just going to touch on some of the things that came from the federal budget. It was a relatively uneventful budget from that point of view. It was a very safe budget. So I'm just going to run through a couple of the things that, if we look back at last year's federal budget, what actually ended up coming through and was passed as legislation, and what are some of the things that didn't, and then what has changed in this budget compared to last year. So tax changes are probably one of the biggest significant things. So the first thing I'm going to touch on is, when we look back on last year's budget, one of the things that the current government talked about was introducing a temporary low to medium income tax offset. So that was introduced. So for those who are lodging their tax returns after the 30th of June, so starting in July, this will be a new tax offset for those who qualify. So up on the screen here, you'll see up to $37,000 worth of taxable income. So just keep in mind, if you're taking money from pensions that are tax-free, that doesn't get added into your personal tax return. So if you've got a little bit of income sitting in your personal tax return up to the $37,000, you'll get around about $200. Up to around about $48,000 to $90,000 is where you get that full $530. For those who are earning over about $126,000, no offset whatsoever. So this was something that was mentioned in the last federal budget, so last year, was introduced, got passed through the Senate, and these tax offsets will be returned to individuals come 1st of July when they lodge their tax return. The second thing was a change to the marginal tax rate slightly. So the highlighted blue figure of $90,000 used to be $87,000. So if you were earned from $37,000 to $87,000, that was slightly increased to $90,000, which reduced tax very slightly for those who earned money above that. That got passed as well, so small changes there. So for those who can recall, in the federal budget last year, there were 3 phases of tax changes. So the first phase was that introductory to the offset. The second phase started with just tinkering around those thresholds there as well. And then the second part of phase 2 was what's going to happen from July 2022 onwards. Again, some more changes. So the $18,000 to the $41,000 bracket up there on your left, so the blue $41,000, that previously used to be $37,000. So they've just increased or given people a little bit more income to earn and only pay 19% tax. The next threshold, which goes up to that $120,000, so that immediately changed to about $90,000, but then they're pushing it to the $120,000. So that's from 2022 onwards was when that was supposed to start. So again, that got passed from that point of view as well. What that did with all the blue figures on the right there, the 4,000, 30,000 and the 52,000, because there was that change, it just meant everyone above that would be paying less tax. Phase 3 of the tax reforms was entirely abolishing the 37% marginal tax rate. So at the moment, the 37% tax rate, so the one that's crossed out there, between $120,000 to $180,000, that was going to completely disappear. And basically, the threshold below, everything would be taxed at 32.5%. So between $41,000 all the way up to $200,000 was only going to be taxed at 32.5%, as opposed to much higher marginal tax rates up to 45%. So these are small tinkerings with where the thresholds are. But the phase 3 was the big one, which was abolishing the 37% threshold altogether, lowering taxes quite massively, and then making the highest marginal tax rate quite high. So $200,000 onwards is where you pay the highest marginal tax rate of 45 cents in the dollar. So what does all that mean? Lots of figures. Here's a simple example. So this is the cheat sheet, I guess. So depending on taxable incomes, this is how much of a total tax benefit someone would receive. So I'll start on $40,000 and I'm going to flick all the way to the very right. So if you're on $40,000 worth of income, your total benefit over 7 years is $2,525. So that's the tax saving you would receive on that level of income. So the first column there, you would get $290 in the first couple of financial years, so 4 years. The next one, you would get a benefit of $455 for the following 2 years, and then you've got 1 year of a saving of $455. So if we add all of that up, tax saving of $2,500. I'm going to flick down to about $100,000. So benefits, around about $3,740 across the 7-year benefit. $160,000 total tax benefits of about $8,415, and then highest marginal tax rate at someone earning $200,000, total tax benefit of $11,815. So very different depending on obviously people's level of income. Again, just keep in mind, people taking tax-free pensions, money out of a tax-free pension over the age of 60 in retirement phase, taxable income personally, is still going to be relatively low. So in terms of, I guess, these 3 phases, the more you earn, the more the tax benefit over that period as well. So a couple of other things that were announced in last year's budget but didn't get a chance to actually get pushed through. So the government tried to push through maximum numbers for self-managed super funds and small APRA funds to increase from 4 to 6. So most self-managed super funds in Australia have 2 members. It's usually mum and dad, and that's it. But there is an ability to add up to 4 people in a self-managed super fund. The government was trying to push it to 6. And there, I guess, was different arguments for that. Like I said, most self-managed super funds only have 2, so it didn't sort of warrant it was an absolute urgent need. But I think with the talk of refundable credits, so Labor's proposed changes with refundable credits. This current government thought if they can push the numbers a little bit higher, they can get more members into a super fund to soak up those credits. The other one that was announced was for auditing of self-managed super funds to not be done every year, but to be done every 3 years. So for super funds that have a great compliance track record, to not have to allow them to audit their super fund every year, it's only once every 3 years. That one didn't go through. Okay, so moving from 4 to 6 members didn't go through. The self-managed super fund auditing relief didn't go through as well. And the super guarantee, which is the bottom one, also didn't go through. And the super guarantee opt-out is where someone is working for multiple employers. They're all paying super, and effectively what happens is by default you actually go over your contribution cap, which then triggers an amendment of a tax return and does all sorts of things. So that was a really sensible policy that probably should have gone through. It will probably still go through even if there's a change in government, because it's just sensible and it's less work for the government to automatically amend tax returns and do all of that sort of thing as well. The one that did go through, which is great, is the work test exemption. So we all know 40 hours in 30 days is what you need to do in order to make contributions into a super fund over the age of 65. What the government proposed and was passed was that there's an additional contribution cap in the year following your retirement to allow you to put extra money into superannuation. So that was only eligible for people with balances of less than $300,000. So it wasn't just that last year that you met the work test, you also had the following year to gather some money together and get it into superannuation as well. So that was a great little incentive, great for people who maybe not have the cash at retirement to get money into super but make changes after the year they retire, have extra money but want to get it into super. The other thing that was changed, which was a good one, was exit fees on super. So there are some really old superannuation funds out there that if you try and get out of them, they charge penalties for effectively getting out of them. So that was banned on all superannuation accounts. And passive fees capped at 3% on balances under $6,000. So for a lot of people who maybe have worked quite a lot, and we're probably more so talking about kids or grandkids here, working in all different jobs, not having too much superannuation sitting in little superannuation accounts, they effectively get eaten up by fees. There'll be a cap on those fees in order to not just see that evaporate from that point of view. The second one there is insurance in super. So insurance and superannuation only being available by an opt-in provision. So again, if I talk about someone who's working 3 or 4 jobs in their early 20s, if they've got 3 or 4 super funds that are established, then generally there's a default insurance that superannuation fund puts in that superannuation fund. That's by default. They don't get a choice. It means that insurance premiums start being taken out of their balance of their superannuation fund. So if someone's got a balance of $1,000, insurance is $300 for the year, it doesn't take too long for that superannuation fund to evaporate. So the government basically said it shouldn't be default, you should actually have to opt in, whereas currently it was opt out. So this one hasn't been passed through the Senate as yet, but it's likely to start in October 2019. For this, just keep in mind, we'll probably be sending out some letters for those who have small superannuation funds that we hold just for insurance purposes. It's likely that you will receive letters directly from your super fund, and we're starting to get some through the office as well, just to basically say, are you aware that you have this insurance? Okay, so they effectively are wanting to make sure that you're opting into that insurance. And the last one there that did get passed through was the lost super. So the ATO is increasing their claim on lost super to balances under $6,000. Basically with all the data, so we talk about big data that companies are collecting, the government knows a lot of information about us all, but what they're wanting to do there is just consolidate balances held by the tax office and throw them into an active account. So the tax office can see which superannuation accounts you've got. Again, if I go back to the example of someone in their early 20s working for 3 different employees with 3 different super funds, 2 might be completely, they're not actually using them. The tax office will find the most active and automatically consolidate it from that point of view. So this is for balances under $6,000. So the whole point of these, proposals and policies from that point of view is to try and stop superannuation funds being eroded with these small balances by costs from that point of view. Other things that got changed around Centrelink, which was good, was the work bonus. So from 1st of July, just gone, the government's increasing the work bonus from $250 to $300 per fortnight. That effectively is what you can earn without affecting your Centrelink entitlements. So just allowing you to earn a little bit more money on a year-to-year basis and not have to worry about, is any of my benefits going to be affected? And self-employed people will also now be eligible for a work bonus. And that was certainly a welcome change there as well. The next thing that got passed was the pension loan scheme. So that's effectively the government's version of a reverse mortgage to part pensioners and nil pensioners. That scheme was then introduced to all Australians. So it's a government way to get finance, which effectively offsets the value of your home. So you borrow effectively against your home. And then there's all rules around that as to how much you can effectively take out of your home as equity to spend on lifestyle and so on. So it's effectively a 50% increase for a part-age pensioner, up to 150% increase of the age pension for a self-funded retiree. So this is a little bit different from, so say for example, a self-funded retiree, if they wanted to take some equity out of their home to pay for the rates and various different things. So the example you always sort of hear about this is the old lady sitting on the Brisbane River in a house. She gets a full age pension, but she can't afford the rates on her house. So this is a way for someone who doesn't ordinarily receive age pension to go through the government to receive this loan scheme. Previously, what happened is if you wanted to do that, you would have to go to a banking institution to try and do that. So this is actually the government scheme. So looking forward, I want to talk a little bit about the election because there's an enormous amount of talk about different policies in the election. I think what the current government did in the federal budget this year was made it really, really boring. They didn't upset too many people in the federal budget, and they've done that on purpose. So it's effectively flicked it to the opposition, who's now got all of these policies that can potentially upset people as well. So what I wanted to go through is just show you a little bit of an example as to what are both parties actually doing and how do they differ. So the first one that I want to talk about is tax rates and thresholds. I then want to touch on negative gearing and capital gains tax. So both parties are dealing with tax rates and thresholds and making changes. When it comes to negative gearing and capital gains tax, it's the Labor Party that is looking at changing the policies. When it comes to superannuation, it's actually both parties that are wanting to make changes to superannuation. And then there's franking credits, which most of you will know that Labor's sort of initiating that. So what this looks at here in this table is what's the difference between both the government and the Labor Party, so in relation to tax benefits. So what you'll see at the top here on the first line, up to $37,000, the current government is giving up to $255 as an immediate increase to that low to medium income tax offset that I talked about initially. So the one that's gone through, what they're also wanting to do is to increase it further. So this is the difference between both parties. So Labor's actually going to give more of an increase in relation to that tax offset, but you'll see at between $48,000 and $90,000 under both parties, it's exactly the same relief or tax offset from that point of view. So basically over $48,000, both parties are the same, but you'll see obviously up to that $48,000 slight changes. So Labor government here is giving a little bit more of that tax offset. Now just keep in mind, these are all policies. So number one, we have to make sure that a party has to obviously get in before they can try and get their policies to legislation. We then have the House of Reps, and then we also have the Senate as well. So whilst these are policies, some of these may not even be able to get pushed through, or there might be some significant changes that need to be made. So this is looking at the current government. Again, what the current government's looking at doing is moving that $41,000 threshold up to $45,000. What does that mean? Everyone just gets a little bit back extra in tax. Going forward, I talked about that abolishment of that 37% marginal tax rate, which means bigger tax benefits for those on $45,000 and above. But here's the cheat sheet. So again, lots of numbers. What does it actually mean? So again, if we look at someone on $40,000, the increase from the previous year's federal budget means that you would then get an extra $1,135 if you're on a $40,000 taxable income. So this is, last year they legislated some changes with the federal budget. This is even more that they're giving back to people in terms of tax savings, all the way up to around about $6,000 in extra tax benefits if you're on the highest marginal tax rate. Another thing that the current government announced that they're looking at doing, and this starts effectively from the 2nd of April 2019, so when the federal budget was announced. If you're in business, you can get an instant write-off currently before these changes of only $25,000. That's now been increased to $30,000. So for someone who's wanting to spend some money on purchasing equipment for business, might be a car or something like that, instant tax deduction, you can write it off in your tax at the time that you effectively, in that year that you're spending that money. There's also tax rate changes. So where that circle is there, you can see the tax rate for entities, as long as your revenue for your business is under $50 million, which is quite large, is dropping from $27,500 all the way down to 25% in 2021-22. So again, just the current government's looking at trying to decrease tax rates there as well through businesses. What the opposition are looking at doing, or what they've announced, is they want to repeal the tax changes from the last budget. So those changes that we talked about in terms of those rebates and so on, changing marginal tax rates, they basically want to repeal those phases of tax benefits. So that's basically what they've introduced, but also with those on $180,000 or more to reintroduce the budget repair levy. So if you're earning on the highest marginal tax rate, if you recall a few years ago, the government called on high income earners to help get the budget back in surplus. They introduced the levy. It was only going to be a temporary levy, but Labor's basically said we're going to keep that going from there. The other thing that the Labor government's also announced that they want to do a minimum tax rate on 30% on discretionary trusts. So for those who have a discretionary trust at the moment, you can distribute income to family members, and obviously you can use marginal tax rates of those family members. So if you've got a non-working adult child, they're studying at university, you've got a family trust, you can stream some income to them, and the first $20,000 is tax-free. The Labor government's looking at a flat rate of 30% on all distributions from family trusts. Negative gearing and capital gains tax. So like I said, the current government's been probably quite strategic in not announcing too much in terms of changes, which has let the Labor government sort of be quite exposed in terms of the changes that they're looking at. So negative gearing is one of them. So these aren't new policies. These are policies that I recall 25 years ago working in accounting. So, you know, one day negative gearing will be abolished. You know, one day capital gains tax exemptions will probably be changed. One day family trusts will probably be taxed different. These aren't new ideas, but they've never had enough legs previously to actually put some weight to them. So they've basically come out and said, look, we're committed to changing them. So negative gearing is if you make a loss on your rental property, that you can't actually offset that against other income. So if you're earning, say for example, $50,000 worth of income, but you make $10,000 worth of loss on your rental property, you only pay tax on $40,000, being the difference. The government's basically saying, no, you still pay tax on that $50,000. So this is only for investments that are purchased from 1st of January 2020. So they're basically saying if you're negatively gearing at the moment, so think about maybe kids that have got rental properties and so on that they've geared quite heavily on, they're going to be fine. But any changes in the ownership of those properties, so if you purchase a property February next year and it's negatively geared, which means you've got borrowings on it, the income doesn't cover all the expenses and you make a loss, you won't be able to claim it. Capital gains tax is the other thing. Again, this is for assets purchased from 1st of January next year as well. If you make a profit on the sale of investment, so let's say you've got I'll stick to the example of the rental property, but this applies to any investments, shares, all that sort of thing as well. So if you've got a rental property worth $500,000 and it grows to $700,000 and you go to sell that investment property, that's a $200,000 gain. So the way the rules work at the moment is you get a 50% exemption. So that $200,000 ends up only being $100,000. So you pay tax on that $100,000. Labor's looking at reducing it to $25,000. So instead of paying tax on $100,000, you'll pay tax on $150,000. So a 25% discount from that $200,000 gain. This won't affect small business capital gains tax discounts. So people running their own businesses, selling businesses, doing all that sort of activity, it doesn't affect them at all. Superannuation, I'm going to touch on this relatively briefly. Not too many changes in terms of the current government. So these are a couple of, I think, positive ones. So at the moment, your age pension age is not 65, it's actually around about 67, nearly 68 for people. But the work test has only allowed you to put money into super up to the age of 65 without meeting a work test. So the government's looking at trying to match those dates. So instead of only being allowed to put money into super up to 65, you can actually then put it in up to your age pension age is what they're moving towards. I think that's a really sensible thing to do there. The other thing that the current government's looking at is from 1st of July 2020, persons up to and including age 74 can still be eligible to receive spouse contributions. So for some of you who are eligible for that, where you've got a spouse maybe not working too much, you can actually get some tax benefits in putting money into their superannuation account. That was currently limited to 69. They're moving it to 74. So again, just some extra incentives. I think the fact that people are living older, working older, these sort of changes to superannuation make a lot of sense. In terms of super guarantee, these are a couple of things that Labor's introducing. So if you are working only part-time and you're only working $400 worth of income or earning $400 worth of income every month, you actually don't get any super. So your employer has no obligation to pay super on that. The Labor government's basically saying it doesn't matter what you earn, you should get superannuation on that. So I think a great incentive in terms of people missing out on that super. From a business point of view, if someone works at Subway for one day and hates it, the employer still has to set up a super fund, pay $20 worth of superannuation on that wage. It might become a little bit cumbersome for business owners from that point of view. Measures that were previously announced but not mentioned in the budget reply that Bill Shorten did, but we know obviously are still policies that they want to do. Again, this is for the Labor government, reducing non-concessional contribution caps from $100,000 per year to 75. So that's just to stop people putting as much money into superannuation. The Division 293 income threshold reducing as well. What that means is basically if you earn $250,000 worth of income or more, you're charged an extra 15% on your contributions that you put into super. So they're looking at reducing that threshold to capture more people to obviously get them to pay that extra tax going into super. The 5-year catch-up on concessional contributions, this was something that was introduced a few years ago and I think is a great incentive, but they're looking at abolishing it. And that is if you're putting money into super each and every year, but you might miss a year, so say for example you might take a year off, you're not well, you're travelling, you're looking after kids at home, you can actually in your next year of employment catch up on those concessional contributions to try and keep your superannuation balance going along. So that was really good. So say for example the cap's $25,000 a year. If I only use $10,000 one year, I get to bank that $15,000 and use it for future years. So I took a year off work, I'm back in the workforce, I want to get my super back to where it should be to try and catch it up. That's what's currently in existence, but they're looking at abolishing that. Removing of tax deductibility of personal contributions for employees. So what this is at the moment, so a couple of years ago, the current government announced that you could put your own contributions into super and claim a personal tax deduction. So I know a lot of people are obviously doing this. So instead of going through your employer to try and say, look, can you salary sacrifice extra into my super for you? It didn't matter whether or not your employer allowed you to do that or not. You could just go and put your own money in, claim a tax deduction in your personal tax return, get a nice refund, but boost your super in a very tax-effective way as well. So this is something that they're wanting to abolish. I'm not entirely sure why. It sounds like a really reasonable thing because there's a lot of employers out there who won't allow employees to salary sacrifice. So there is no option for them to boost their superannuation in a tax-effective way. So it's a bit of potluck. In terms of employees, this sort of bypassed that and said if you want to boost your super, it doesn't matter who you work for, you can do it. And the other thing that the Labor government's looking at doing is introducing the super guarantee increases. So we're trying to get to around about 12%, but just pushing that forward. So in terms of people who are working for employers, that compulsory superannuation, which is 9.5% at the moment, increasing that to 12%, but at a faster rate from that point of view. The other thing that Labor touched on is, and this sort of came into, they sort of mentioned this a couple of years ago with the $1.6 million cap that you can have in superannuation tax-free. Labor basically said, no, we don't want a $1.6 million cap. We just want anything that retirees earn over $75,000 in their super fund to then be taxed at 15%. So it's a different sort of taxing mechanism. So this one I think would be costly to implement. I think people could manipulate this a lot more. But basically what they're saying is we'll allow people with superannuation to have tax-free pensions, but only so much. Anything after that will be taxed. So different sort of rules. So the current government has something like this, but it's called a $1.6 million transfer balance cap. Okay, franking credits. This is the one that everyone gets fired up on. So it doesn't matter. I always say I appreciate both sides of every argument. This one is one that I can personally see both sides, and both sides make sense, but everyone gets fired up about this. So again, the current government's been very quiet about anything around these sort of things. It's the opposition that's basically come out and said, we're looking at changing this. So this is removing refundable credits for imputation credits that you get back, whether it's personally. So if you've got a child that has $10,000 in shares, they get that dividend income, they're studying at university, and they're getting imputation credits back by lodging a simple tax return each year. It affects those people. It affects the 80-year-olds who don't have super but have investments sitting in their own name and are getting refunds of imputation credits. It affects people who have superannuation funds as well. So this is a policy that was introduced back in the late 80s by the Labor government when Howard came into policy. So basically back then it was you get the use of your imputation credits, but you don't get a refund. John Howard then came in and introduced, you get your imputation credits, but you get to keep your refund. And now what they're looking at is reverting back to 20 years ago, effectively. So there are a couple of exemptions to this. So basically anyone who had or gets a pension or allowance from the government will still get their imputation credits back. Self-managed super funds with at least one age pensioner or allowance recipient as of 28th of March 2018 will be exempt as well. Where the Labor government probably hasn't been enormously transparent, as most politicians are, I've spent the last week and a half talking with Chris Bowen's office about these sort of rules. But if you weren't a pensioner on the 28th of March 2018 and became a pensioner on the 29th of March 2018, you will be affected by this. So there's some real devil in the detail around this, which is as much as if they get this in, and like I said, I appreciate and understand both sides of it, there are some clear people who will be affected very differently with this policy depending on their personal circumstances. So it's not a lot of feedback that I'm getting from a lot of people talking in the community is, but I'm X, I'm not affected. It's like, well, it depends. And then other people are saying, I am affected. And I say, well, how are you affected? And then they tell me, and I go, well, actually, you're not. So there is lots and lots of confusion around this. So the biggest thing we've been trying to do, particularly in review meetings over the last 6 to 12 months, is talk to you individually about your own circumstances. So if you're unclear of that, feel free to give us a call. We're more than happy to take you through that. But the devil is in the detail in terms of this. Really, really simply, the thing that Labor government promoted about this was that we're hitting the big end of town. I actually disagree with that. So people who have enormous amounts sitting in superannuation, and I've got an article going in the paper on the weekend, which is multimillionaires. There are some multimillionaires that are not affected by this whatsoever and will continue to receive their refunds. So, and these are the figures on how much you might have in super, and I actually think the people who are most affected by these changes is if you've got $800,000 to about $3 million worth of money. If you've got over that, you're actually not too affected. If you've got under that, you might be captured by the pension guarantee, but only if you're age pension age. If you're not age pension age, then you might be affected even with less than that. So the rules are not the same for everyone. There's a lot of confusion about this. On this table, what I've done is looked at 5 different scenarios, depending on whether you've got $800,000, $1.5 million, $3 million, $5 million, or $10 million. The people who are getting the refunds in these scenarios are those at $800,000 and, in terms of the net refund, so you can see on that table there, you've got a franking credit of $3,400, you've got taxable income of $52,000, less the franking credit if you're not paying any tax whatsoever, you would get $3,429 back. So that person would lose it from that point of view. If we look at the person with $10 million sitting in superannuation, they have a franking credit of $42,500 or just under $43,000. Their portfolio, because of how much they have in super, they don't actually get a lot of tax-free money because they've got over that $1.6 million. So the tax they pay is $66,000. They get the benefit of the franking credit, but they actually pay tax of $23,000. So they're not the ones getting the tax refunds. So where people are getting the most hit, you can see around that $3 million mark, they were getting a $13,000 refund, and they're going to lose that, but the person on $10 million is laughing all the way to the bank. So these are really specific, and like I said, as much as it might be a policy that was already in existence, and it might be a great policy from that point of view in terms of bringing it back, like I said, I see both sides of it. It's not hitting where they say they're hitting it. And there's examples that I've done with, 80-year-olds sitting with $800,000 who will lose 30% of their income with these rules. There are examples where a divorcee with 3 children will lose more than someone with $3 million in super. There are flaws within the policy, and they need to really look at that if they want to try and push it through. But I think a lot of that, if we do see a change in government, which might actually be quite likely, I think there's going to be a lot of toing and froing to try and get this through the Senate, because in its current form, there's a lot of issues, and as soon as I talk about this in the media, everyone just gets in a big flurry about it. So it's a very, very contentious topic from that point of view. So something to keep an eye out for. A couple of other things that the government's looking at is automatic reporting for employment to Centrelink. So if you're reporting employment to Centrelink, you don't have to call up and ring and do all of that. They're hoping to make that all automatic. Increase to energy assistance for Centrelink recipients, changes to residential aged care places, home care packages, which is really good, but we're still way behind. So the current government introduced about another $100,000 at-home care packages, which means getting help into your home to stop you from moving to an aged care facility. We're still a couple of 100,000 places or packages behind. Great to see, but we're still way, way behind in terms of what the current government's doing. ATO divisions to tackle tax integrity. There's lots of audits going on. There's lots of ways that they're gaining revenue from that point of view. And also there's changes to business loans out of companies as well. Couple of last things with self-managed super funds, just to give you a quick update. We've got $2.7 trillion sitting in superannuation. So enormous amount sitting in superannuation at the moment. Total self-managed super funds at the end of last year, about nearly 600,000, so we're at all-time record highs. Net decrease in self-managed super funds for the December quarter when we saw the big drop in the markets. Self-managed super funds dropped by about 3%. APRA funds, which is pretty much everything else, dropped by about 4%. Our total members are now sitting at just over 1.1 million, so there's 1.1 million people in Australia who have self-managed super funds. And that's pretty much it. That's my cue. Thank you very much, guys.